Hello, everyone, and welcome to another edition of CEO and Market Expert Interviews. I'm your host, Lucian. Some of you know me as Triangle Investor from social medias. After a great interview a few weeks ago with Michael Oliver, I got a lot of messages from you trying to bring Michael again to my show. And there he is. Michael, welcome back. Delighted to have you once again.
Good to be back.
Thanks, Mike. In our prior interview, which link I will leave in the description of this video, we discussed the Fed, the market crash scenarios, and bear markets, and much more. I know that you are projecting the biggest bear market in the US history after this almost 15 years of bull market supported by money supply growth and low interest rates. But what series of events do you believe will lead to a market crash and the bear market period?
Well, I think the fundamentals for the event have already happened in that if in fact, and I think this is the case, the bull market of the last 15 years, which is the oldest in US history, the biggest multiple gain in US history. For the S&P, it's like 7-8-fold. For NASDAQ 100, it's like double that, 16-17-fold even. Okay, so if that is an error, meaning it is not genuine market forces, but monetary issues driving it, the cheapening of money, free money for probably 10 of those 15 years, et cetera, then it creates errors. Errors not just on the part of individual investors, but corporations make judgments based on one of the major factors, cost of money, okay? So if you make a commitment over the next X number of years based on the cost of money where they think it is, which was like free for a while, then they've made an error. And so that's the event that drives it, is the unwinding of the errors, micro, macro, governmental level, the whole deal, And it's suddenly everybody had a needle in their arm for 15 years, and it's been yanked out. And when the Fed tries to put it back in, it never works. You go back and look at the 2000 top through 2002, the dot-com top. NASDAQ dropped 82%. They cut rates all the way down aggressively, didn't stop it. 2007, 1 month from the high, they cut rates for the first time in a couple of years for a problem they claimed didn't exist, namely the mortgage crisis. They cut rates 0.5%, market went up for 2-3 more weeks. That was the top. Market collapsed for the next year and a half. They cut rates all the way down. So if the Fed tries to come in now, and they've already said they're going to cut rates, it's not going to do any good. The error has been committed.
Yeah, you got that right. So the gold is just warming up in your scenario. I mean, it is showing consistent strength. Silver, on the other hand, has performed weaker than gold. How are you seeing gold and silver performing next?
Silver is a wild dog, we call it, on a leash, and the leash is held by gold. So what gold ultimately does, silver's going to do too. Okay. The problem is that silver both runs ahead of gold like a wild dog, and then sometimes runs behind gold. And for example, you go look at April high in gold. Gold hit 24.50, okay, US dollars. Silver at that point hit just short of 30. This is mid-April. Gold went sideways from mid-April through recently, basically with highs in the upper 2400s, could never get to 2500. But silver, after the April high, went up into May and got to 32.70. It was 10% beyond its April high. So it ran ahead of gold. And then in July, silver went down and ran behind gold. So it's just a reality of silver. However, for the remainder of what's to come, and we're focused right now on the next couple months primarily. Yeah. Not that that's going to end it, but that should be a dramatic phase. Silver will outpace gold. That's our argument. And the gold miners, which have been dogs for the last several years compared to gold, gold went sideways from 2020 through 2023. The miners went down. Okay, but they're coming to life big time. Look at Newmont Mine, for example, the biggest gold miner in the world. They're like 37% more gold they put out than in the next big miner, Barrick Gold. Okay, they're the blue chip. Suddenly, some asset managers are starting to buy Newmont Mining. In fact, a major asset manager in the U.S., Druckenmiller, back in mid-February, said he's going to get out of some tech stocks and go into Newmont. Okay, well, Newmont then was $32. Right now, yesterday it traded up to 52. Okay, 6 months, it's gone up 60%. Not bad. So there's an asset flow, I think, into that category. And I think the miners will, for a period of time here, the next several months to a year, let's say, outperform gold again. Again, they're like a wild dog on a leash.
Yeah, you see that even in a scenario where we will see a market correction of 20, 30%, something like that, you believe that the miners will decouple from the markets?
Yes, I do. Their spread relationship between the miners and the S&P, of course, is very depressed. We know that they're very undervalued, and they're not going to collapse anymore. They've had their collapse. They spent the last 10 years laying in the mud. Okay, they've come to life. Certain asset managers perceive risk-reward ratios, and they see high risk, low reward remaining in the stock market. And they see in the gold miners low risk, great potential reward, given where they are. Now, that's a broad view. Okay, we look at it more specifically and technically. There may be a crash event in the stock market. It doesn't have to be. From 2000 to 2002, I don't think the S&P.com ever had a crash event. A crash event being something that within 2 weeks you drop 30+%, like 1929, 1987, the COVID event in January of 2020. Those were crash events, and they took place within a matter of weeks and more than the 30% drop. There's a potential for that in this next quarter for the S&P. Potential for and the NASDAQ 100 especially. But gold does not always respond that way. If you go back and look at the 87 crash, well, the market crashed for a week and a half, 2 weeks, gold went up. Okay. You go back to the 1929 to 32 era, there was no legalized gold then, but homestake mining went off the page on the upside.
Yeah.
Well, the stock market was decimated. Okay, so don't make that connection that everyone makes. They think it is carved in stone that if the stock market goes down, so will gold and silver. There was a brief incident in 2008 where gold had been advancing big, silver too. Stock market had a crash event late in its bull market, in its bear market. It had already been a year off its high. It's October of 2008. And finally, it had a puke, 30-something% drop rapidly. Gold and silver participated in that. But it was a correction within their uptrend. It wasn't, they didn't join it and continue down through 2009. In fact, they went right back to their highs. That's the only memory that people seem to have. The connection between, if the market goes down, gold must go. That's a bad linkage.
Yeah, I agreed actually on that. Mike, what is your take on the gold to silver ratio? I mean, it is, in my opinion, indicating silver relative undervaluation compared to historical averages. What's your take, and what's your take on that? And what ratio would actually be the realistic one?
Well, we've plotted it many times. What we do is we divide an ounce of silver into an ounce of gold. A lot of people do the ratio. We divide silver into gold, and right now it's 1.1 something percent the price of gold. Okay, you go back over the last 50 years and find the peak spread reading between silver and gold, dividing silver into gold, and plot that as a column chart, 50 years of data. You'll find that probably a third of the years involved in that 50-year process, silver reached up to about 2% of the price of gold. Some of these years weren't even bull years. Okay, it's not uncommon for it to get to 2.5 to 3% of the price of gold. So these aren't like aberrational highs. In fact, back in the 1980 period, silver was 6.5% price of gold. Forget that. But even just normal hiccups in the spread, it gets up to 2.5%. Right now, so that means if silver were 2% and gold went up to, had an 8-fold move, okay? 8-fold, well, why do I say that? Because the bull markets in the past 50 years have each reached at least 8-fold dimension. And so gold with 8,000 with silver 2%, well, you do the math, okay? It's off the page. It's off the page. Silver also has some other unique things. And by the way, that spread is beginning to turn. The silver versus gold spread. It is beginning to turn. It already broke out a very decent technical structure back in March, coincident with silver's first surge. There's another level we're watching up about 1.3% plus If you can get a monthly close of silver where it's more than 1.3 something, we put it in our reports, there's another breakout level on the spread. And when we see that, we think we could gush up to that 2%, the 2.5% zone on silver, again, which is not some extraordinary level. So we think that's going to happen. And we think the dynamics are there. And silver also has, its own unique dynamics. We've seen in the past 5-10 years, things like lithium and iron ore go ballistic on the upside for brief periods of time because there's something unique in the supply-demand situation. It came and went. But in the case of silver and gold, gold is more of a constant. It's a smooth mover. It doesn't have supply surprises or demand surprises. Silver, on the other hand, has that aspect. So that you could get a situation where the fairly tight supply situation could become a mini crisis of sorts, where suddenly there's a perception, my gosh, there's not enough silver to cover China's demand for photovoltaic cells. They're 80-90% of the solar market. That market's exploding annually in terms of demand, and they need silver for it. And it's increasing geometrically year by year, their demand for silver. Yeah. And so it's those type of variables, or in Mexico, for example, the government's talking about closing all open pit mines. Well, it's a minority of silver mines, but there's quite a few silver mines that are open pit, and they're the largest silver producing country in the world. So, if they execute that, it could impact some mines. These variables can cause silver to go berserk, is what I'm saying.
Sure. You mentioned technicals and silver, and I want to touch on that a bit. With charts, we are seeing silver cup and handle right now. Do you believe will it trigger a bigger move soon?
Yeah. If you just look at price itself, then we look at momentum, meaning we look at price as reflection as measured by momentum, meaning measuring price against certain long-term moving averages. And I don't mean overlaying an average where you cross it. Sometimes crossing an average is meaningless information. But we oscillate it and we create a chart that sometimes, quite often, will look different from the price chart of silver. And right now, it's far more dynamic looking than the price of silver is. The momentum's stronger looking than when you look at a price chart. But let's just look at price, for example. You made a peak at $32, rounded off to $1 increments here. Let's say you're a point and figure guy, X's, O's, okay? You put upticks to 32, okay? Then you drop to 29, okay? 3 down ticks. And then, lo and behold, you went back up to 32 again. Bump, 3 upticks back to a double top at 32. Okay, then you came down and flushed that low at 29 by putting a 28 and a 27, circled down ticks. So you've cleaned out a prior low, used it for whatever it was worth in terms of downside. And now suddenly you put 3 upticks back on the board. You traded 30 yesterday.
Yeah.
You ever touch 32 again, you're sitting at a triple top, and I'll guarantee it will not stop there. Okay. You'll have a price chart, point and figure, triple top breakout, touch 33. And I suspect the price guys, a lot of whom have been doubters, will suddenly say, that's it. I'm either in or I'm not being short anymore, okay? So the awareness will smack them in the face if you go back to that high. There's similar things going on in the miners. We've got a momentum breakout pending on GDX, for example, quarterly momentum that spans a ceiling on momentum that you can't see on a price chart. But if you get over 40, specifically 40.24, and we get up just short of 40 yesterday on GDX, you go a little bit higher than yesterday's high, and I'm going to blow out a massive ceiling on quarterly momentum that says I'm launching. It won't crawl higher anymore. It's going to zip. Okay. Yeah, we have those type of technicals that are building. And in the case of silver's price, I think what will happen is you smack them in the face with the 32 print again, and they're going to start to wake up.
Yeah. If I ask you to put a number or a price range on silver and gold this time next year, what would you say?
I don't know. I really don't. No, there's some intelligent folks who have their own reasons that are discussing mid-20,000 gold and so forth. And all I can say is historically over 50 years, if you go back to the mid-1970s and look where gold was in 1980, 7-8 years later, it went from the mid-$30 range to 850. Okay. Look at the 2000 basing period, 2000, 2001, we were $250, $260. By 2011, you're what? 1,920. Okay, you do the multiples. Okay,
Yeah.
right now we're starting from a low at 1,050. We're only double, and we're up 140%. So far, dimensionally, relative speaking, it's a much more timid bull market than those were. But remember, most of those bull gains came in the last year of those bull markets,
Yeah.
where gold went vertical, silver went even more vertical. I think we're in that period now. We're about to enter that. Our focus is more, though, on the next 2 to 3 months. Not that it's going to end then, but I think much drama can occur between now and October in terms of percentage gain. Okay.
Short term, then. Okay. How is this all affecting T-bonds, and what is your general thoughts on T-bonds?
Well, T-bonds are that alternative asset you hold in the 60-40 ratio stock portfolio, right? 60% stocks, 40% bonds. If you held that in 2022, you were killed on both sides. In fact, bonds went down more on a percent basis in price than did the stock market. So it was a terrible place to be. It was not an alternative. Now, if you look at the 2007 top in the S&P through 2009, bonds went up. Price yields went down. Gold went up. Okay. Look at the 2000 top in stocks to the 2002 low. Gold and bonds went up in price. Stocks went down. T-bonds had been moving fairly in sync with gold over the last year or so until recently, when gold made its low in February and shot up into the April period. T-bonds were still laboring. They had a massive momentum base they could break out of, and they broke out of it the end of last month, getting above 120 on the T-bond futures. T-bond futures are now 125. So they've had a good squirt in the last 3 or so weeks. Yeah. They have now joined gold as a viable asset alternative, meaning normal portfolio managers who were getting nervous about the stock market, who are skeptical, and there's a lot of them that are, but they still have to be long the market because they're competing with people who are, and if they don't make money in the stock market, they lose customers. But give them the least excuse and they'll start to shift assets. And I think they've already done so, like Newmont Mining. But they've also begun to move into T-bonds, back to the normal alternative. And so T-bonds and gold are both expressing directional movement that is alternative to stock market likely trend movement.
Yeah. Mike, do you believe that now is a good time to increase a personal cash balance, or you would go almost all in on precious metals, leaving the cash position at the minimum necessary levels?
My definition of cash is gold.
Okay.
It is money. Okay. Other cash depreciates year by bloody year. Every decade, our money supply almost doubles. Going back to the 1950s, it almost doubles every decade. This past decade, even more so. So your money, if you hold it in dollar cash, is depreciating every year by hefty single percentages. So, you may get a savings account where you get 5% or 4% or whatever. It's offset by the deterioration in the real. Okay, gold is cash. So if you want to go to cash, and you hold leveraged positions in the monetary metals like calls or futures, and you feel nervous and you want to go to cash, bullion. Okay. That's my suggestion. Okay.
Great suggestion.
Okay.
And I believe the same thing, just like you. What about real estate? We touched on the real estate for the last time you were in my show. Do you believe it will be a pain all over residential, commercial, industrial real estate? Do you believe they will be affected equally in the, let's say, in the next period when we will see pain?
We know in 2007 through 2009, it was the mortgage market. So it was real estate, but it wasn't the commercial end. It was more the residential end. Yeah. This time it's more commercial. And if you look at a commercial real estate ETFs like RWR, for example, and look at it and compare it to an S&P chart, they're in different universes. They both broke down in 2022. RWR went sideways and has gone halfway back up to its highs, whereas S&P made new highs. So yeah, it's rallied with the S&P in a struggling manner, but I strongly suspect that it's vulnerable for another leg down. Now, I'm not going to say that this time it's commercial real estate is the sole cause here. Like you could narrow it to .com would be the internet stocks, or 2007 through 2009 was the mortgage market. I think it's much broader this time. And yes, commercial real estate is likely a a victim yet again. It was in 2022 and likely to be again. And that may cause some financial issues beyond the commercial real estate, namely the lenders, that are involved in this.
Yes.
So that we widen it to banks again, which also have not gone back to their highs in terms of the indexes. So I don't think that's an opportune place to be looking. I know there's been some recent firmness there, but along with the stock market. Why? Because they know the Fed is going to cut. And they think, oh boy, everything's okay. Well, again, when the Fed cut in 2007 in October, was everything okay? Okay. No.
Yeah, definitely. Just a short answer. What do you think? What's your take on the Fed next move?
On what? On what?
On Fed's next move.
Oh, yeah. Oh, they're going to cut. We know that. Okay. They've already explained, even back in July, early, Powell said, yeah, too much focus on the inflation issue can hurt us by staying rates too long, too high. It can cause damage. Even if we don't see the damage yet, we know it could cause damage, and we don't want to wait for the damage. So in effect, he's saying, even without data points, we want to cut. And they've had enough of the, quote, inflation numbers subside to where they can say, oh, okay, we're okay in that regard. Now let's focus on the other mandate, which is economic damage, unemployment, and so forth. So they're itching to cut. There's 100% odds now. It didn't used to be this way. A few months ago, it was December. Now there's 100% bet September's the cut. Okay, fine. They have a meeting this week, up just north of where I am right now. I'm northern Colorado. They'll be in Wyoming. Okay, maybe they'll do something then. Maybe the market's hoping, But again, when they do something, it's not because things are good. Okay,
yeah,
they're doing something because they're worried about something they haven't overtly stated, but it's there. And as I explained early on, we have a compounded decade and a half of errors. They're going to expose themselves in various ways, and the Fed will have to face that and panic, and they'll go the other way, and we know that. So will the ECB, and so it's not just the Fed. Anyway, so yeah, the rate cuts are coming, and the only question is how aggressive, how quickly, and I don't know, but it doesn't matter.
Yeah,
they're going in that direction. Yeah,
definitely. Mike, how can investors and my followers reach out to you and become subscribers of your content?
Well, the website is olivermsa.com. MSA for Momentum Structural Analysis. To the site, there's a section there called Our Value. Scroll down, we talk about our methodology. Some of our archived reports are there on the stock market especially. And there's a video at the bottom that's semi-humorous, explaining our method in a humorous way. But anyway, we cover all four major asset categories. So debt markets, stock markets, commodities, especially gold, silver, and the foreign exchange markets, which, by the way, are about to come to life. The dollar is about to head down in a serious way. It's already broken most of our structures. So that's about to become a player again. But anyway, it's good to look wide when you look at markets. Don't just look at gold. Don't just look at the stock market. They impact each other.
Yeah. I'm a proud subscriber, great content. So this is my disclaimer. I am your subscriber, and I really believe that it is a top-notch subscription, and I believe that the value for the money is brilliant. Michael, thank you very much for coming to my show. It was a great chat as always, and I look forward to host you again sometime soon.
Have me back again. I love it. Thank you much.